What's going on, everyone? Welcome back to Trade Radar USA, the channel where we break down the markets without the noise. Today, we're covering the latest US stock market action as Wall Street pushes into record high territory right before the holiday break. The S&P 500, Nasdaq, and Dow are all making headlines. But the real story is what's driving this move and what it means heading into 2026. Quick reminder, if you want daily market clarity, hit subscribe and turn on notifications. Let's get into it. Let's start with the numbers. The S&P 500 closed at a fresh all-time high, marking its fourth consecutive green session. The rally wasn't explosive, but it was steady, which matters more at this stage of the cycle. The Nasdaq outperformed, gaining more than the broader market as technology and AI-linked stocks continued to lead. Meanwhile, the Dow Jones also finished higher, showing participation from traditional blue-chip names, a sign this rally isn't purely speculative. This type of price action is classic late December behavior, often referred to as the Santa rally, where lower volume and positive sentiment push markets higher into year-end. So what's actually behind this move? First, economic strength. Recent GDP data showed stronger than expected growth, reinforcing the idea that the US economy is not slowing as fast as many predicted. That's bullish for earnings and risk assets. Second, tech leadership. Large cap tech and AI-related names continue to act as the market's backbone. These stocks are attracting capital because they offer growth visibility even in a higher rate environment. Third, sector rotation. We're not just seeing tech move. Healthcare and consumer discretionary stocks also showed strength, suggesting investors are selectively positioning rather than blindly buying everything. Now here's where Trade Radar USA keeps it real. Despite record highs, market breadth remains thin. That means fewer stocks are actually carrying the indexes higher. Even more important, small cap stocks lagged, with the Russell 2000 finishing lower. That divergence matters. When big indexes rise but small caps struggle, it often signals concentration risk, defensive positioning beneath the surface, or a rally being driven by a handful of giants. This doesn't mean a crash is coming, but it does mean complacency is dangerous. Another major factor, interest rates. Strong economic data has reduced expectations for aggressive rate cuts in early 2026. Bond yields remain elevated, and that directly impacts stock valuations, growth stock sensitivity, risk appetite going forward. In simple terms, the economy looks strong, but the Fed doesn't need to rush. That balance is what markets are currently digesting. Looking ahead, most major firms expect 2026 to be positive, but volatile. Earnings growth is expected to support equities, but risks are rising. High valuations in AI stocks. Geopolitical uncertainty, policy shifts tied to interest rates. This environment rewards discipline, not hype. Here's what you should remember from today's market action. Record highs don't mean risk is gone. Tech leadership remains critical. Market breadth matters more than headlines. Strong data today affects Fed decisions tomorrow. Whether you're trading short-term or investing long-term, risk management matters more than ever. That's it for today's breakdown here on Trade Radar USA. If this helped you understand the market better, hit like, subscribe, and turn on notifications so you don't miss our next update. Drop a comment below. Are you bullish heading into 2026 or preparing for volatility? Thanks for watching, and I'll see you in the next one.